So today the topic that we'll be studying is money multiplier and credit creation by commercial banks. So we have already studied what is money supply, its definition, what are the aggregates used in India. Now we should know that what is the money multiplier and how does the commercial banks create credit. Through creation of credit, banks increase the supply of money in an economy, which has a direct impact on the production, consumption, and level of investment, and along with it on the process of development, and prosperity is also influenced. So that is why studying about the money multiplier and the credit creation is very important. So let's study about that. So before that, the first thing that we have to study is money multiplier. So what is money multiplier? See, money multiplier is the ratio of change in the supply of money to the change in the monetary base. If you remember, I had taught that MS, which is your money supply, is equal to the money multiplier, which is denoted by small m, and the high powered money or the monetary base, which is H. So from here we can write the money multiplier small m is equal to the ratio of money supply MS upon H. And that is what we are saying here, that money multiplier is the ratio of change in the supply of money to the change in the monetary base. See, monetary base is the sum of the currency in circulation and the cash reserves of the banks. So if as a result of a change of rupees 10 crores in the monetary base, so we are saying that monetary base is changing by 10 crores. So we can change the denominator H as 10. There is a change of rupees 30 crore in the supply of money. So we can say the money supply changes by rupees 30 crore. Then the money multiplier will be, we can see that it will be how much? It will be 30 upon 10, which is 3, as is written here that the money multiplier is 3. So we can easily see that money multiplier is the ratio of change in the money supply. So we can write it as change in the money supply to the change in the monetary base. Now let's go to the next slide and see the formula for the same. So as we can see, the formula for money multiplier is money supply upon the high powered money, or as I had said before, small m is equal to capital M upon H, where small m is the money multiplier. Capital M is the supply of money, which includes currency in circulation and banks demand deposits, and H denotes the high powered money. Now what is this supply of money? So the total supply of money is the sum of the currency and the demand deposits. So I can write it as capital M is equal to C, which is the currency, plus D, which is the demand deposits with the banks. So now first let's see what is the difference between the money supply and the high powered money. So supply of money is in which currency and demand deposits are included, and high powered money includes the currency and the reserves of the commercial bank. Now what are the reserves of the commercial bank? One is the cash reserves, which include the minimum required reserves of the commercial banks and the excess reserves. See, the minimum required reserves we have already talked, they are the CRR, which the banks have to keep with themselves, and the SLR, which is the banks have to keep with the RBI. So CRR was cash reserve ratio and SLR was statutory liquidity ratio. So these are the reserves, or we can say the minimum required reserves that the banks have to keep with themselves or the central bank. And then the remaining deposits are known as excess reserves. So total supply of high powered money is equal to the sum of currency, the required reserves of the banks, other deposits of the banks, and excess reserves with the central bank. So we can write it as H is equal to C plus RR plus ER. So what is H? H is the high powered money. C is the currency. RR is the required reserves of the commercial banks. By required, we mean that this much amount of reserves have to be kept by the commercial banks. And ER is the excess reserves with the central bank. This means that they are the excess amount of reserves which either the banks can keep or they can use it for credit creation. So this is not a required reserve. Okay, so let's go to the next slide. So if in equation 1 of money multiplier we substitute the values of M and H, we will get the equation money multiplier is equal to M upon H. Now M is C plus D and H is C plus RR plus ER. Now if we divide all this right side of the equation with D, which is the demand deposits. So what we will get it as? It will become C upon D plus D upon D upon C upon D plus RR upon D plus ER upon D. So now what will we write this as? We will write C upon D, which is currency upon demand deposits, as small c. Then the required reserves upon demand deposit, we will write it as R, and then the excess reserves upon demand deposits, we will write it as E. And this term D upon D will cut and it will become 1. So now let's see what will be the equation of the money multiplier in the next slide. So now let's see what has the equation of money multiplier come out to be. So it is small m, which is equal to money supply upon high powered money. We can write it as 1 up plus C upon C plus R plus E. Now we can also write the supply of money from this equation as the money multiplier into the high powered money. So capital M becomes 1 plus C upon C plus R plus E, which is the money multiplier, into the high powered money, or small m into H. So this is the supply of money. And high powered money can be written as supply of money upon the money multiplier. So we can see that the supply of money is influenced by the money multiplier and is a main component or main factor which affects the supply of money. So let's go to the next slide and read about the credit creation or expansion of credit money. So now let's read about the expansion of credit money or credit creation as done by the banks. So money supply in an economy depends on the circulation of currency and the demand deposits of the commercial banks. So due to any increase in any of these two components, money supply in the economy will increase because they are directly related. Now the quantity of currency is decided by the central bank, which depends on the government's nature of spending, whereas the deposit constituent of money supply is influenced by the commercial banks. How do they do that? Commercial banks influence the money supply in the economy by credit creation or expanding the credit money. So we have already studied a bit about that about this in brief, that commercial banks use the money deposited by the consumers, the individuals, or we can say the people in the banks, and we know that at one point of time the number of deposits is more than the number of uh, deposits demanded by the consumers back. So that difference is used by the banks for credit creation as they give loans from that. So that is how commercial banks influence the money supply by credit creation or by creation of loans. So let's read more about this. So credit creation capacity of commercial banks depends on their cash reserve ratio, which we write as CRR. What is this cash reserve ratio? It is the reserves that the banks have to keep with themselves, and this is given or mandated by the central bank, which is Reserve Bank of India. So in the words of Lipsey and Crystal, banks can create money by issuing more promises to pay deposits than they have the cash reserve available to pay out. Similarly, in the words of Newland, credit creation refers to the power of commercial banks to expand secondary deposits either through the process of making loans or through investment in securities. As per J. N. Ham, the creation of derivative deposits is identical with what is commonly called the creation of credit. So you can see that how important the process of credit creation is to different economies. Now, the quantity of currency in India is decided by the Reserve Bank of India. So now we know that we have to read the process of credit creation, but before this, some knowledge of some basic concepts should be known. So let's read about that in the next slide. So the first basic concept that we should know is about deposits. That is, what is deposits? See, those deposits of the bank which the depositor may withdraw at any time by drawing a check are known as demand deposits. They are also known as checking deposits or checkable deposits. So the everyday deposits that we keep in banks are known as demand deposits, because whenever we demand money from those deposits to the bank, then the bank has to give our money back. That is why they are known as demand deposits, checking deposits, or checkable deposits. So its detailed classification is, now first there is something known as primary or cash deposits. So the amount of money which is deposited by the people in the form of cash in the banks is known as primary or cash deposits. So our currency deposits, our savings deposits, all these are primary or cash deposits because we deposit cash with the banks. It is also known as passive deposit because banks have no role in developing these deposits. Amount of these deposits completely depends on the will of depositor. See, what do we mean by this last line? See, it could be that a consumer wants to put in only 100 rupees in his banks, or maybe he wants to put in 1 crore. So this depends, this amount of the deposits depends on my will, that is on the will of the depositor, and it has no role of the banks. So that is why this is known as a passive deposit. Okay, so now let's go to the next classification. Now, the second classification of deposits is known as derivatives or secondary deposits. See, when a person takes a loan from the bank does not give him this loan in form of cash, but opens an account at his name and gives him a right to withdraw money from it through check. You would have seen your parents doing the same, that when they take out loan, then they don't get cash from the banks. What they get is they get an account in their name which has the same amount of loan that they have taken from the banks, and they can withdraw money from this account through check. So such a deposit is known as derivative or the secondary deposit. Hence, each loan given by a bank creates a new deposit. So secondary deposit is the result of primary deposit. Why? Because banks create secondary deposit by keeping a part of primary deposit itself in the reserve. So we know that banks get primary deposits from the depositor. Now, the amount demanded every day by the consumers or by the depositors is less than what has been deposited in the banks. Yes, so this difference of reserves after keeping an amount of required reserves, what is left is the excess reserves. So this excess reserves is used by the banks to create secondary deposit or to create loans. That is why according to economist Ham, creation of secondary deposit is credit creation. Larger the amount that a bank advances, greater is the creation of secondary deposits or loans created. That is why it is said loans create deposits and deposits create loans. So we can write the demand deposits as equal to primary deposits plus derivative or secondary deposits. So this is all about the concept of deposits. Now we should know what is the cash reserve ratio. So we know that banks want to earn more and more profits by giving loans, but it does not mean that they can lend their entire cash. The people who deposit their money in bank may withdraw it anytime because it is their money. Hence bank always keep a part of the net deposits in form of cash reserves with themselves so that the requirement of the depositors may be fulfilled. So this part of net deposit which the banks keep with themselves as cash is known as the cash reserve ratio. Similarly, there is something known as excess reserves. See, these are the amount with the bank which is more than the required cash reserve ratio, and this is known as excess reserves. It is this excess reserves which becomes the base of credit creation. See, let me give you an example. See, the banks maybe got 100 rupees as deposits. Now, of this 100 rupees, maybe they decided to keep 20%. Okay, so maybe their CRR, cash reserve ratio, is 20%. So what will be 20% of 100 rupees? It will be rupees 20. So this is the amount of reserves that they will keep with themselves in case some depositor asks for their money back. So this is the reserves, CRR. Now the amount remaining is how much? It is rupees 80. So this 80 is what? This 80 is the excess reserves, which is ER, or we can even write it as excess reserves ERR. So this 80 rupees is the amount which the banks use for credit creation. That is, this is the amount with which they give out loans. Yes. So now I hope it is clear what is CRR and what is the excess reserve. So the next concept that we should know is credit multiplier. The ratio of increase in the primary deposits and increase in the total deposits is known as the credit multiplier. So if as a result of an increase of rupees 1000 in primary deposits, what was primary deposits? It was the deposits put in the banks by the depositors. There is a credit creation of rupees 10,000. So credit multiplier will be what? It will be 10 rupees. See, what was the ratio here? Primary deposits. So 1000, and the increase in total deposits, how much is that? That is 10,000. So we can easily see that what is the credit multiplier? It is 10, as all these zeros get cut with these zeros. So we get the credit multiplier as 10. So there is an inverse relationship between the credit multiplier and the cash reserve ratio. What is it? See, credit multiplier is equal to 1 upon cash reserve ratio. So now we have already studied something known as money multiplier, and now we have also studied credit multiplier. So what is the difference between these two? See, money multiplier was the ratio of the supply of money and the high powered money, which we had written as 1 plus C upon C plus R plus E. Or we could also write it as supply of money upon the high powered money. Here what was C? This was the currency upon the deposits. What was R? This was the required reserves, or we can even say the cash reserve ratio, and the SLR upon the deposits. What was E? This was the excess reserves upon the deposits. Yes. Now, what is the credit multiplier? See, it is the ratio of increase in total deposits and increase in the primary deposits of the banks, or it is also the reciprocal of the cash reserve ratio CRR. So we can write credit multiplier as change in total deposits upon change in primary deposits, which is equal to 1 upon R, which is the cash reserve ratio. So R is the reserve ratio, D is the total deposits, P is the primary deposits, and in this way we can see the difference between the money multiplier and the credit multiplier. So now let's study about the process of credit creation, or we can say how do banks create credit. So the commercial bank's method of credit creation is based on two conditions. First is that the stability in cash reserve ratio of banks. So the cash reserve ratio or the net commercial deposits of bank remain constant during the process of credit creation. Second is no flow of cash. This means that excessive flow of cash should not happen from the banking system. That is, people should keep a designated amount of currency with them for exchange. So the study of process of credit creation can be done in two parts. One is the single banking system and another is the multiple banking system. So let's read about both of them in the next slide. So credit creation in a single banking system. See, this makes it very easy. So it is an easy assumption that in an economy, only one bank does all the banking business. So even though we know it is not so, but to understand our process of credit creation, first let's start with this assumption that there is only one bank which does all the banking business. So assume that there is Mr. X who deposits 1000 rupees in the bank. So in the form of primary deposit, this amount is demand deposit of the bank on the assumption that CRR is 10%. So let's see what will be the bank's balance sheet. So we are taking the primary deposit being rupees 1000. Now there is liabilities and there is assets. Assets is what are the bank's asset. Liabilities is something that banks will have to pay back or pay off. So these demand deposits or the primary deposits are the bank's liability. So this 1000 rupees is a liability because the consumers, the customer, or here in this case Mr. X, can anytime demand back this 1000 rupees and the bank will have to pay it back. Now let's see in the assets. So firstly, this deposit the banks get in the form of cash. So there is 1,000 rupees cash as assets which the bank have. Now in this case, they keep the cash reserve as what? We have taken it as 10%. So 10% of 1,000 rupees is 100 rupees. So this will be the cash reserve fund that the banks will keep with themselves in case of emergencies. The remaining amount will be what? They will be the excess reserves. So 1,000 rupees minus the 100 rupees, which is the 900 rupees, is the excess reserves. We can see that the total in both case, in liabilities case, in assets case, is what? It is the 1,000 rupees. Now we know that this excess reserve, the 900 rupees, can be used by the bank to create loans or to create credit. So let's see that in the next slide. Now, as I said that the banks can give the loans of rupees 900 from these excess reserves if there is no liquidity or a security risk. So if bank does so, we had read that what do they do? When giving these loans, they create secondary deposits or derivatives. Now, since there is only one bank, so that means this secondary deposit or this derivative will also be with this bank, right? So now let's see the balance sheet of the bank when the initial excess reserves is converted to loans. So in the liabilities case, they have the demand deposits or the primary deposits, which was 1,000 rupees. And then with the excess reserves, they created a loan account, which is another demand deposit of 900 rupees. See, this is the secondary and the derivative deposits, and this deposit can be taken out by the person who took the loan, and that is why it is a liability. So the total is what? It is 1900 rupees. Now let's see the asset sides. So there we had received the cash of 1,000 rupees. We had kept cash reserve fund of 100 rupees, and the excess reserve was 1,000 minus 100, which was 900 rupees. Now of this 900 rupees, we gave out loan of 900 rupees, which is again an asset for us. Why? Because we will get interest on this. So this 1,000, the cash received, plus this 900 gives the total 1,900 rupees. And again, we have a balance between the asset sides and the liabilities side. So this is the balance sheet when the banks have given a loan from the excess reserves of 900 rupees. So now let's study that what will happen to this 900 rupees loan amount. So where does the loan amount of rupees 900 go? See, if the person taking the loan gives the check of rupees 900 to another person who has an account in the same bank, then there is no disturbance in the bank's cash reserve of rupees 1,000. See, what do we mean here is that maybe the person who has taken this loan will give it to another person in the form of check, maybe to buy something, maybe to buy AC, maybe to buy fridge or anything, right? So then this person will do what? He will deposit this check. He will deposit this check in the bank, and if he has an account in the same bank, then there will be no disturbance in the bank's cash reserve of rupees 1,000. So banks demand deposits become 1,900, 1,000 plus 900, for which again it will have to keep a cash reserve fund, which will be what? 10% of 1,900. So it is how much? Rupees 190. So 190 rupees will be kept as the cash reserve fund. What will be the remaining amount? So the bank is left with an excess reserve of 1,000 rupees minus 190, which is rupees 810. So now this 810 rupees can be used to give out another loan by the bank. So let's see the balance sheet and how does this happen. So now the bank's demand deposit will increase with 1,000 rupees plus 900, which was the first loan, plus 810, which was the second loan. So now he has total demand deposits of 2710 rupees. Now if the person who took the loan of rupees 810 gives the check to another person and he has an account with the same bank, so then there will be again no disturbance in the bank's cash reserve of rupees 1000. Now again, of this amount, banks will have to keep a cash reserve fund, and the remaining amount will be what? The excess reserves. So what will be the cash reserve fund? It will be 10% of 2710, which is 271 rupees. So banks will keep 271 rupees in the cash reserve fund for demand deposit of 2710, and what will be left will be the excess reserve of rupees 729. How did we get this? 1000 minus 271. So it will be given in the form of loan to some other person. Now till when will this process keep on going? So the process of giving loan by the banks will go on until the excess reserves become zero. So what will be the bank's balance sheet then? Let's see it in the next slide. So let's see the balance sheet of the banks when the excess reserves end completely, or that is they become zero. So the demand deposits in the liabilities case were divided in two parts. One will be the primary deposit, which was deposited firstly, and then the secondary and derivative deposits which were made by the banks by giving loans. So primary deposit was 1000 rupees, and from that they made secondary deposit of 900 rupees, 810 rupees, then 729 rupees, and this cycle will go on until this excess fund does not become zero. Now let's see the asset side. So in asset side, we initially received a cash of 1000 rupees, and from then on onwards, after keeping the cash reserve funds, we kept on giving loans from the excess reserves. So the first loan was of 900 rupees, then second was of 810 rupees, then third was 729 rupees. So you can see that this is the same amount. Yes, and again this process will keep on going till the excess fund does not becomes zero, because at that time we will have no amount to give as loans. So here also the total will come out to be 10,000 rupees, and even in asset side the total comes out to be 10,000 rupees. So this is our balance sheet of the banks. So now we saw that on the basis of cash received of 1000 rupees, banks created a demand deposits of 10,000 rupees. Now if we see the example of credit multiplier, so 1 upon CRR into the deposits. CRR was how much? 1 upon 10%. So 1 upon 10% into 1000 rupees comes out to be 10,000 rupees, because in our example the credit multiplier is 10 and credit multiplier was 1 upon CRR, which is equal to 1 upon 10%, which is 10. So there is an increase of 10,000 rupees in the supply of money or credit in the economy. So what can we conclude? On an initial increase of 1000 rupees in bank's demand deposit, which was in the form of primary deposit, and on the basis of the assumption that CRR was how much? CRR was 10%. The bank's demand deposit, which was the sum of the primary deposits and the sum of the secondary deposits, how much did it increase to? It increased to 10,000 rupees. So if I want to write it as a formula, how can I write it? I can write the process of credit creation as change in the demand deposits, because of initial change in primary deposits will be equal to change in P, which is the change in primary deposit plus change in P into 1 minus R. Here R is the cash reserve ratio plus change in P into 1 minus R whole square plus change in primary deposits into 1 minus R whole cube, and this will go on till last our last term will be plus and so on. So change in P into 1 minus R raised to power n. So here change in D is what? It is the net change in demand deposits because the initial change in primary deposit. Change in P is the change in primary deposit, and here R is the cash reserve ratio. If you will put in these values here, then you will get the change in total deposits as how much? It will be 10,000 rupees. So now we are done with the credit expansion in single banking system. So now let's study the credit expansion in multiple banking system. So credit process in multiple banking system is like the single banking system only, but here the banking system increases its multiple credit creation when all banks increase their deposit amounts with each other. So in comparison to the single banking system, credit expansion process in the multiple banking system is more realistic. Why is it more realistic? Because even now we can see that there are many banks and not just a single bank. So there are many banks in reality too, and that is why this case is more realistic. So let's take an example that in an economy there are many other banks like A, B, C and so on. So firstly, a person deposits rupees 1000 as primary deposit in bank A. So now in this case, what will be the balance sheet of bank A? Let's see it in the next slide. So the initial balance sheet of bank A, again it will be divided in liabilities and in assets. So a person has deposited 1000 rupees in bank A. This is a liability because this is a demand deposit, that is on demand the banks have to return back this amount. Then on asset sides there will be reserves. So this deposits will be as reserves of 1000 rupees. Again the total on both sides is what? It is 1000 rupees. Now bank A will keep the cash reserve fund. Let's take it as 10%. So he will keep 10% of 1000 rupees will be what? 100 rupees, and the remaining 90% is what? 900 rupees. So this excess reserves will be given as loan. So in such a situation, the final bank balance sheet of bank A will be, so the liabilities will be the deposits, which is 1000 rupees, and assets is the reserves, which is the cash reserve fund of 100 rupees, plus loans of the excess reserves, which is 900 rupees, and the total remains the same, which is the 1000 rupees. So liabilities and assets are the same. So now bank A has given a loan of 900 rupees. So assume that the person who takes the loan of 900 rupees from bank A, he gives a check of this 900 rupees for paying off debt to another person. But that person has an account in bank B and not bank A. So the initial balance sheet of bank B will change this time. So there will be liabilities and assets. So in liabilities, he got a deposit of 900 rupees, and that 900 rupees got added as his reserves in the asset sides. So total liabilities is equal to the total assets. Now bank B will again keep 10% of this primary deposit of 900 rupees as cash reserve ratio, or we can say cash reserve fund, and give the balance of the excess reserves, which is rupees 810, as the loan. So his final balance sheet will become. Let's see it in the next slide. So the final balance sheet of Bank B will be in liabilities he got the deposits of 900 rupees. In asset sides he is keeping the CRR or cash reserve fund as 90 rupees of 900. So it is 10% of the deposits, which is 900 rupees. So 10% of 900 rupees is how much? That is 90. And the remaining amount, which will be what? It will be 900 minus 90. Yes, so this is what? This is 810 rupees. So he gives out this remaining amount as loan or the excess reserves as loans. So you can again see the total is 900 rupees on the asset side and the liabilities side. Now, suppose the person who borrows this 810 rupees from bank B, he uses it for repayment of debt and gives a check to the another person. Now, this person has an account with bank C. So, in such a situation, the initial balance sheet of bank C will change. What will it become? There will be a deposit in the liability side of 810 rupees, and this will also work as a reserves in the asset sides. So the assets and the liabilities are equal, which is 810 rupees on both sides. So the bank C, after keeping 10% of primary deposits, which is 810 rupees as cash reserve ratio, or we can say the cash reserve fund, he will give the balance rupees 729 as loan. So the final balance sheet of bank C will be what? Deposit sides he got 810 rupees. From that he kept 10% of 810 rupees as cash reserve fund because that is the CRR, which is 81 rupees. The remaining amount, which was 729 rupees, was given out as loans by him. How did we get this 729? It was 810 minus 81. So again you can see the total of assets come out to be 810. The total of liabilities is 810, and again our assets and liabilities are equal. So this process of credit expansion will go on until the primary deposit of 1000 rupees does not get distributed in the complete banking system in the form of reserve funds. So all banks will collectively create a new deposit worth of rupees 9000, and deposit of total banking system will be 10,000 as in the case of single banking system. Even there we started the primary deposit with 1000 rupees and we got the deposit of total banking system as 10,000 rupees. Let's see it through a table. So let's see the whole process of credit creation by this table. So the A bank got new deposit of 1000 rupees. He kept 100 rupees as CRR or cash reserve fund and gave out the remaining excess reserves of 900 rupees as new loans. That new loan was deposited in bank B as new deposits. Then from that 900 rupees he kept 90 rupees as the cash reserve fund and gave the remaining amount as a new loan, which was 810 rupees. Then that 810 rupees was deposited in bank C, which again kept 81 rupees as the cash reserve fund and spent the remaining amount 729 as new loan. Now again that loan will be deposited in some other bank, which will again keep some amount of CRR and give the remaining amount as a new loan. So this process keeps on going till the time the total for the banking system becomes 10,000. The CRR will be 1000 rupees and the new loans given will be 9000 rupees. So change in total deposits can be found by multiplying the primary deposit with the credit multiplier. Our credit multiplier was how much? It was 10, or and how did we find this? which was 1 upon CRR. So 1 upon 10% and our credit multiplier was 10 rupees. How much was my primary deposit? It was 1000 rupees. So change in total deposit is primary deposit 1000 rupees into credit multiplier, which is 10,000 rupees. So we can see that the total deposit of the complete banking system because of the primary deposit of 1000 rupees became 10,000 rupees as in the case of single banking system. And we can easily say that the single banking system and the multiple banking system are basically same. Now let's study about some limitations to this process of credit creation. See, banks want to get more and more profit, but banks cannot create credit in unlimited quantity because there are many limitations to the credit creation power of the commercial banks. So let's study about these limitations. The first limitation is the cash reserve ratio. Firstly, what is cash reserve ratio? Cash reserve ratio is the amount that the banks have to keep with themselves as reserves in case of emergencies, that is in case there is demand from the public for their cash. So the power of credit creation mainly depends on the cash reserve ratio. We have already seen that credit multiplier is equal to 1 upon CRR, and hence our credit creation depends on cash reserve ratio. So there is a mutually inverse relationship between the credit creation and the cash reserve ratio. So if the cash reserve ratio will be high, the credit creation will be less. And similarly, if the cash reserve ratio will be less, then the credit creation or creation of credit will be more. So let's see it through an example. So in this example, we are going to study three cases. First is when the CRR, or we can denote it by R, is 10%, then when R is 5%, and when CRR is 20%, what happens? In all three cases, we are taking primary deposit as 1000 rupees. Now, how can we find the increase in total deposit? So it will be change in D. This is the increase in total deposit, which will be equal to 1 upon R. Here R is what? This is the cash reserve ratio. And what is change in P? This is the increase in the primary deposit. So 1 upon 10% into 1000 will give us 10,000. 1 upon 5% into 1000 will give us 20,000. And 1 upon 20% into 1000 will give us 5,000 rupees. Now what is the credit creation here? 10,000, which is the increase in total deposits, minus the primary deposits. So credit creation in the first case when CRR is 10% is 9,000. When CRR is 5%, credit creation is 19,000. And when CRR is 20%, the credit creation is 4,000. So we can see that when the cash reserve ratio will be 10%, increase in deposit is 10,000 rupees. When cash reserve ratio increases to 20%, so increase in total deposit is just 5,000 rupees. And the when cash reserve ratio decreases to 5%, then increase in total deposits will be 20,000 rupees. So we can easily see the inverse relationship between the cash reserve ratio and the credit creation. I hope this is clear. So, the next limitation to the power of credit creation is the amount of primary deposits. We know that amount of primary deposits is not changed by the banks. It depends on the depositors. So, they have no role. That means the banks have no roles in the amount of primary deposits. So, the expansion of credit creation depends on the quantity of the primary deposits, and there is a direct relationship between the credit creation and the primary deposit. That means if the quantity of primary deposit is more, the creation of credit will also be more. And if the quantity of primary deposit is less, then the creation of credit will also be less, even if the cash reserve ratio remains constant. Let's see it from an example. So see, we are taking the increase in primary deposits or the change in primary deposits as 1000 rupees in the first case, 500 rupees in the second case, and 2000 rupees in the third case. In all three cases, we are taking the cash reserve ratio to be constant, that is 10%. So we can see that the change or the increase in total deposits, when our primary deposits is 1000 rupees, then the change in total deposits is 10,000. When we decrease the primary deposits to 500 rupees, then the change in total deposits is only 5,000 rupees. But when we increase our primary deposits to 2000 rupees, then change in total deposits is a high amount, which is 20,000 rupees. So if the cash reserve ratio remains constant, then there is a mutual direct relationship between the primary deposit and the total deposit, and since it is in the hands of the public, so it is again a limitation in the credit creation power of the banks. So the third limitation is banking habits of the people. So the bank's power of creating credit also depends on the banking habits of the people. If people do their business mainly through check, then they will need to keep very little cash with them. As a result, the cash with the banks will increase, because of which their power of credit creation will also increase. But if public keeps less cash with the banks, then their power of credit creation will decrease. So in developed countries of the world, we can see that public keeps more cash with the banks. But in underdeveloped countries, people mainly do their business through cash. As a result, their demand for cash is always more. And because of this, the cash balance of bank reduces or is less. And because of this, their power to create credit will also decrease. Hence, the banking habits of the people is also important. Another policy, which is the credit policy of the central bank, also affects the power of the commercial banks to create credit. See, if the central banks follow cheap credit policy, what do we mean by that? Credit expansion policy. So credit creation power of the commercial banks will increase. But if the central banks follow expensive credit policy, that means a controlled credit policy, then the credit creation power of the commercial banks reduces. So fifth point is policy of other banks. The power of credit creation by one bank is also dependent on the credit policy adopted by the other banks. If all banks work in the same tune, then their power of credit creation will be more. But if one bank expands credit but other banks do not cooperate with it, then the process of credit creation will be limited. Another thing that limits the power of credit creation is confidence of depositors. So power of commercial banks to create credits is also influenced by this. See, if the depositors have full faith on the banking system, then they will let their money lie in the bank. It will increase the credit creation power of the banks. See, if we have full faith that the banking system is going well and our money is safe in the banks, so we will keep our money in the banks rather than keeping it in cash, and this will increase the credit creation power of the banks. But if people do not have faith in the banking system, then they will not keep their savings in the banks. This is what happens with poor people when they don't have financial literacy, so they keep more money in their hands rather than keep it in banks. So due to this, less amount of cash balance with the banks reduces their credit creation power, and that is why confidence of depositors on the banks is also an important influencer on the power of credit creation by the banks. So the last 2 points are, the seventh is the availability of good borrowers. See, this also affects the credit creation power of the banks. If such borrowers, that is good borrowers, are available in big numbers, then more credit will be created. What do we mean by good borrowers? Good borrowers are basically those people that return their amount that they have taken as loans timely. So if good borrowers are not available, then banks will hesitate in giving them loans and credit creation will be limited. Then the last is commercial and industrial conditions. So during the period of recession, businessmen's and industrialists' demand for loan is very less because already there is a period of recession, so demand for loan will obviously be less. Hence, not much credit is created by banks in the form of secondary deposits. But during boom period, giving loans is profitable for the banks and they create more credit in the form of secondary deposits. That is why what is the condition of the economy at that time period is also important, as it affects the bank's credit creation power. So among all these points, the two main parameters that limit the credit creation capacity of the commercial banks was, first is your primary deposits of the commercial banks, or we can say the cash reserves, and second is the cash reserve ratio or CRR, which is determined by the central bank. So now that we are done with the limitations to credit creation capacity, we have to next study about the competitive banking and the credit expansion. So we know that commercial banks also work for profit. According to the perspective of credit expansion, commercial banks, through the medium of credit expansion, want to maximize their profits. How do they do that? See, they accept deposits. We have already studied that. When they accept deposits, they give interest rates to the customers. Similarly, they give out loans. So when they give out loans, they charge interest rates from the customers. So this difference between this interest rates is how the banks earn their profits. But credit expansion is not always possible, as we read before this, that there are many limitations to the credit expansion capacity of the banks. So banks, with the help of primary deposits of the people, increase the secondary deposits and expand credit. But in the current competitive age, commercial banks, in order to maximize their profits and for expanding credit, they try other measures. Banks keep excess reserves with them which fulfill the increasing credit requirement in the money market. So for expanding credit and increasing the profits, commercial banks plan their policies, demand and the supply parameters of the money markets. So in the competitive banking system, quantity of credit of banks is determined by demand and the supply of loans. So let's go to the next slide. So we can see that the demand for loan depends on the prevailing interest rates and the supply of loan depends on the quantity of deposits. Deposits by whom? Deposits by the customers, which we can say are the primary deposits, and the spread of interest rates. Now what is this spread of interest rates? See what interest rate banks give for accepting deposits from people and what interest rate banks charge for giving loans to the people. The difference between them is known as the spread of interest rates. As I just discussed that there is a difference in the interest rate and this spread helps them to get profits. So spread of interest rate is decided by the loan supply line and the deposit supply line. So what is loan supply line? The supply of loans, and the deposit supply line is the supply of deposits. When we talk about the demand for loans, then it is inversely related to interest rates. See, excessive interest rates reduces demand for loan and less interest rate increases demand for loan. So in this manner, the loan demand curve is a downward falling line, or we can say it is a downward sloping curve. Now see, why is it inversely related? So when we take a loan, then the interest rates have to be paid by us. And with the time, this amount, the interest amount that we have to pay, it increases. So no one will want to pay high interest rate. And that is why demand for loan is inversely related to the interest rates. When the interest rate is low, then the demand for loans is high. And similarly, when the interest rates are high, then the demand for loans is low, because then not many people would want to take loans. So let's go to the next slide. So the supply of loan and the supply of deposit, they are directly related to the rate of interest. Why? See, who does this supply of loan and supply of deposits? It is done by the banks, right? So when they supply, then they will be getting this interest rate. So if this interest rate increases, then the amount that they will be getting will be high. It also increases, and that is why the supply of loan and the supply of deposit are directly related to the interest rate. On high interest rates, banks do a greater supply of money and people deposit more cash in banks. So what happens is that when people get high interest rate on their savings, on their deposits, so when they get high interest rate, then they will deposit their money more rather than keeping their cash in hand. But similarly, if they get low interest rate, then there is no point in keeping their money in banks. They can keep it in hand. So at that time, the demand deposit decreases. When the demand deposit decreases or the primary deposits decreases, we have already studied that this will limit the credit creation capacity of banks. So on high interest rates, banks do a greater supply of money and people deposit more cash in the banks. So that is why the slope of both loan supply and the deposit supply line is upward. So let's see this through this diagram. So we can see that SL is the line for supply of loan, which is upward sloping. Similarly, SD is the line for supply of deposit, which is again what? It is upward sloping. And DL is the demand curve for loans, which we have already studied will be downward sloping. The balance rate of interest is OR. So this OR is what? This amount is the balance rate of interest where the demand for loans is equal to the supply of loans. And this point E will give me my equilibrium point where I get the balanced rate of interest. And this M is the amount of loans and the deposits that will be supplied and demanded in the market at the balanced rate of interest, or we can say at equilibrium. So you can see this diagram that point E is the point of equilibrium. Now what are this R1? So you can see that it is at point, it is along the curve SD, so supply of deposits. So this is the rate of interest which is given in deposits. So this difference between R, that is OR, and OR1 gives us the spread of interest rates, and this spread helps the banks to earn profits. So I hope this is clear. So it is that rate of interest. Which one we are talking about? We are talking about OR rate of interest, where demand of loans and supply of loans is equal. So it is that rate of interest which banks receives for giving loans to the people. As I said, OR1 is what? It is the rate of interest which banks gives to the people on deposit amount. So difference between both interest rates RR1 is the spread of the interest rate which determines the quantity. We had seen the quantity was M. So the quantity of loan supply by the banks. So in the figure we saw that the interest rate spread is assumed to be constant, and that is why the loan supply curve and the deposit supply curve were mutually parallel. So the quantity of loan supply by the banks depends on the interest rate spread and the deposit supply. So interest rate spread is what? It is the difference between the interest rates which is given on loan and which is charged on the deposits, and the deposit supply line. So on both of this, the quantity of loan supply depends. Now let's go to the next slide. Now, does supply of money in the economy depend on the discretion of the central bank? So what we are trying to find is that does the supply of money only depends on the central bank? So is it only central bank that determines the supply of money? So the answer is no. The supply of money in the economy does not depend on the discretion of the central bank. In India, which is our central bank, it is the RBI, which is the Reserve Bank of India. So Reserve Bank of India of our country is the issuing authority of currency of the country. But the net supply of money does not only depend upon the discretion of the central. So, the net supply of money in an economy depends on the nature and the below given factors. Now, what are these factors that influence the net supply of money? So, first is the central bank of the country. Second is the commercial bank of the country, and third is the general public. So now let's see how does these three affect our net supply of money in the economy. So deciding the quantity of high powered money which does the job of money multiplier, the central bank does determine its supply. So we have already studied that money supply is equal to what? The money multiplier into the high powered money, where the high powered money has two components. One is the currency and another is the reserves of the banks. So by deciding the quantity of high powered money which does the job of money multiplier, so this is determined by what? The central bank. And in this way, central bank determines the supply of money as we can see here. Now, by determining the cash reserve ratio, which is the base of the credit multiplier, commercial banks influence the supply of money. So, we had read what was the formula of the credit multiplier. It was 1 upon CRR. What was the CRR? CRR is the cash reserve ratio, which is the amount of reserves that bank keep with themselves so as to use them for emergency purposes. So by determining this cash reserve ratio, commercial banks influence the supply of money. See, in single banking case, we had read that this credit multiplier into our H gave us the money supply. And similarly, if you remember the formula of money multiplier, it also included your CRR. How? So money multiplier was equal to 1 plus your C upon C plus R plus E. Now what was this C? This was cash deposits upon your cash upon deposits or currency upon deposits. Again, this C is currency upon deposits. R is what? R is your this reserve ratio. So reserves RR upon deposits, and E was the excess reserves upon deposits. So how does this R come into play? It is this reserves fund comes from your cash reserve ratio, and this is determined by the commercial banks. So the amount of reserve funds that the commercial banks keep with themselves influence the supply of money. We had read that there is an inverse relationship between the supply of money and the cash reserve ratio. Now, how does general public determine or influence the supply of money? General public do that by determining their preference for liquidity, and through this they influence the supply of money. It determines the cash reserve ratio of the commercial banks and hence their power to create credit. Now firstly, what is this preference for liquidity? See, this preference for liquidity means that how much amount of cash does the public or the people want to keep in hand and how much they want to keep with the banks. So if they keep more amount with the banks, that means primary deposits will be higher, and if primary deposits will be higher, then what will happen? Their credit capacity will increase. But If people want to keep cash in hand more and less money in the banks, then the credit capacity will decrease. So by determining their preference for liquidity, general public influence the supply of money. So let's go to the next slide. Now, another point that influences our money supply is velocity of money. So, velocity of money should not be ignored. It means how many times one unit of money, like a note or a coin, is used as a means of exchange. So, one example that we have done this of that let's take suppose that average times a single unit of money exchanges hands 7 times in a year. So this means that a single unit has been used as 7 units of money, and then we can say that the transaction velocity of money V is equal to what? 7. So this is what we mean when we say that how many times one unit of money is used as a means of exchange. So if this velocity of money is measured in the form of per unit time, period, or in the form of flowing concept, then it will also be an important determinant of money supply. If you remember, we had read that money supply is equal to, so supply of money, this is supply of money is equal to the quantity of money into the circulation velocity, that is how many times the money is being circulated in the economy. And in this way, velocity also affects our money supply. So with this, we are finished with the topics of the unit. So in the next slide, now we will discuss some key points that we have discussed throughout the unit. So firstly, what is money supply? See, money supply shows the quantity of money available in the economy for business. It is a stock concept which is measured on a definite time. So this is what the quantity of money. We had written money supply as what? Money supply was equal to the money multiplier small m into the high powered money. It shows us all the quantity of money available in the economy for business. Now what were the components of money supply? So the two main components of money supply which has been accepted by everyone is, first one is the currency and second one is the demand deposits. Now what were the monetary aggregates used in India? So according to the old measures, they were M1, M2, M3 and M4. But according to the new measures, there were monetary and liquidity aggregates. They were NM2, NM3, L1, L2 and L3. Now what were the factors which influence this money supply? So we just read these factors. One is your size of the monetary base. Second is the ratio of the cash and demand. And third is your velocity. So now what is money multiplier? See, money multiplier is the ratio of change in the money supply and change in the monetary base. So small m, which is the multiplier, is equal to the change in the money supply upon the change in the monetary base, which is H. We had done another formula was for this, which was 1 plus C. So this was currency upon deposits. So C plus R was required reserves upon deposits, plus E. So E was what? E was the excess reserves upon deposits. So this gives me my money multiplier. Now, what is the high powered money H here? See, it is that money which is issued by the central bank or the government and is kept with themselves by the publics or the commercial banks. So, we had read that this high powered money H is equal to what? It is equal to the currency which the public keep with themselves plus the reserves. So, reserves are kept by the commercial banks. Now, what is the credit multiplier? So, credit multiplier is the ratio between the change in total deposits. So, if I write it as change in total deposits as D and the change in primary deposits. So, upon the change in primary deposits. This gives me my credit multiplier. Another formula for credit multiplier was 1 upon cash reserve ratio CRR. So we had read that the credit multiplier is inversely related to the cash reserve ratio. Now demand deposits. See, it is that amount kept by the people with the bank which may be withdrawn any time through the check. So the money that we deposit with the banks is what is our demand deposits, and they are also known as checkable deposits because they can be withdrawn anytime through the check. Now demand deposits were of two types. One was your primary deposit and another was your secondary deposits. So what were these primary deposits? See, the amount deposited as cash by the people in the bank, this is known as the primary deposit. So basically the cash that we put in or deposit in the banks is our primary deposits, and these deposits are used by the banks for credit creation. Now what are secondary deposits? So derivatives or secondary deposits. See, derivative deposit is the result of primary deposit because commercial banks keeping a part of primary deposit. What is this? These are the reserves that they keep aside in the form of money. They create secondary deposit. So we had read about this. What happens is that the banks have demand deposit, or we can say the primary deposit. Then they keep a part of this, which is what CRR, which is the cash reserve ratio, into the primary deposit, and we get what? We get our reserve fund. So the remaining amount, which is the primary deposit minus this. So that is what? That is my excess reserves fund. And this excess reserves fund is used by banks to give loans. So when they give out loan, what the customer does it? He deposits that loan amount in another bank. And that is how the credit creation is done. So these deposits in the banks, they are known as derivatives or the secondary deposits. So when they give out loans, this loan account becomes the secondary deposit. So it is a result of what? The primary deposit, because commercial banks create the secondary deposit through them. Now what is the cash reserve ratio? See, that part of total deposit which the commercial bank keep with themselves as cash is known as cash reserve ratio. I have already discussed this. Now what are the excess reserves? So the cash reserve that remains with the bank in excess of cash reserve ratio is known as excess reserves. So what do we mean by that? So what is this excess of cash reserve ratio? So we are basically saying that you have to subtract this reserve fund from the total deposits, or you can say the primary deposits, and the remaining amount that is with the bank is your excess reserve or excess reserves fund. Now what are the principal parameters that delimit the credit creation capacity of commercial banks? So in total we had done 8 limitations which limit the capacity of banks to create credit. But among them there were two principal parameters. What were that? One was the cash reserve of the commercial banks, or it is actually the primary deposits. So why do they limit the credit creation? Because primary deposits are deposited by the public, and if they deposit less amount, then credit creation capacity is less. Second is the cash reserve ratio of the central bank. So if the cash reserve ratio is high, then credit capacity is low, because there is what? There is an inverse relationship between the cash reserve ratio and the credit creation capacity. So let's see what are the limitations. So limitations of credit creation. So as I said, we had done 8 limitations. So first was the cash reserve ratio. So as I just discussed, on cash reserve ratio being more, the quantity of credit creation will be what? It will be less, so it reduces. Second is the amount of primary deposit. So more primary deposits show more credit creation capacity, as there is a positive relationship between primary deposits and credit creation capacity. Third is the banking habit of the people. See, by more use of banking services by people, more credit will be created, because in that way the primary deposits will increase. And we just read that if the primary deposits increase, then what will happen is there will be more credit creation. Now fourth is the credit policy of the central bank. So there can be two types of policy. One is cheap and another is what? Expensive credit policy. So when there is cheap credit policy of central banks, so that means they want to expand the credit and it provides the facility of more credit creation. But when there is expensive credit policy, that means that it is a controlling credit policy, and in this case the credit creation will decline. So the fifth is the credit policy of other banks. See, if banks do not cooperate with each other, then the credit creation will be less. But if all banks work united, then more credit will be created by all the banks. Sixth is the confidence of depositors. See, if the depositors are confident among the banks, then they will deposit more amounts. That means the primary deposits will increase, and that will lead to the increase in credit creation capacity. But if the depositors have no confidence in their banks, or if there is a situation of panic, then they will deposit less money or no money with the banks. And when there will be no primary deposits, then automatically there will be no credit creation capacity or less credit creation capacity. Now seventh is the availability of good borrowers. Who are good borrowers? Good borrowers were the ones who used to give back their loans timely. So if there are good borrowers available, then banks will be ready to give more loans and the credit creation capacity will increase. Eighth one was the commercial and the industrial conditions, where we had talked about two situations. One was your boom and another was what? It was recession. So when there was boom, more loans will be given, more people will be willing to take loans and credit creation capacity will increase. But when there will be recession, less loans will be given and less people will be willing to take loans, so the credit creation capacity will decrease. So with this, we are done with this unit.